Hello and welcome to Cloud 9fin. I'm Chase Collum, head of podcast here at 9fin, and today I'm joined by Scott Alintoff, FIS. We're doing the third episode in a series of podcasts about the big picture around loan data and also the middle office services sector and what's happening there. So, Scott, why don't you introduce yourself? Let everybody know who you are.
Yeah, no, I'd be happy to. And I guess this is the third. So I guess we're saving the best for last. So, or something like that.
Exactly.
Or maybe they're all equally good. But yeah, I'm Scott Alintoff. I work for FIS. We're a very, very large software and services provider. I work in our capital markets division, and I work in an area around our FIS loan services suite. And I oversee our business that really focuses on that. So looking at things like middle office services, settlement services, we have a fund administration business, structured finance and collateral administration, all of those kinds of things. So it's a very interesting business, and it's an interesting time in the market as well.
Right. Yeah. Interesting time in the market, to say the least. I mean, we've got the tariffs, we've got inflation, the trade war going on around the tariffs, everything. Why don't we start by talking a little bit about that and maybe put us into the perspective where you see things at FIS? Where are we today? What's the macro picture as you see it, as it concerns, especially considering that we're talking about global loan data, the collation of that data, the managing of that data, and the middle office services that sort of work with that. So.
Yeah, I mean, look, I think we have to start, like you said, with the macro picture, looking at tariffs, what's happening in the markets. The way I think about it right now is that, look, everybody's trying to digest where we are with tariffs. But I kind of think about tariffs the way that I thought about inflation when it was first coming back up at the end of the pandemic, where, it was every time there was a new inflation number being broadcast, everybody was watching the TV to see exactly, well, how big is the number? Is it 8%, 9%? But then over time, you start to adjust your expectations. You start to get comfortable with, okay, we're in a higher inflationary period. We still are in a higher inflationary period, right? So it's over time, things tend to normalize. So right now, where we are, and I look at the credit markets, there was definitely this big freeze, right? Everybody said like, let me just stop doing deals. Let me see what's going on. Let me try to measure, what is going to happen. So we saw that initial kind of freeze, and the bond market was seizing up a little bit. And that's when President Trump said, you know what, we're going to have this 90-day pause. And what I hear, and we talk to a lot of clients, talk to people all over the street, there are still deals being done. I mean, so there was that initial kind of freeze, like, okay, like the deer in headlights, what does this mean? What are we going to do about this? But the reality is that there's still a lot of liquidity out there. And that liquidity needs to find a home. It needs to be put to work. And there are still deals being done. Now, what worries me personally about this whole, tariffs and where are we going and what does it mean for the markets is that, today countries are fighting. Well, like maybe it's just us fighting, but there's these fights going on around physical goods, right? It's tariffs on physical goods. But could that spill over to investments that you make in a foreign country? Could it spill over to tourism or other services? Maybe. And if that chatter starts to kind of percolate up, well, yeah, then we're going to have a whole nother kind of a reset and kind of a freeze. But for right now, the credit markets are functioning. Like I said, our clients are doing deals. We are, there are CLOs being launched. I mean, there's maybe a little bit less activity, but it's still there. And my sense, I guess, to summarize, is that we are going into that kind of, okay, we need to get everybody comfortable with the fact that tariffs are going to come. There's probably some hit to the consumer, probably some hit to the companies as well in the form of earnings. But at the end of the day, we still need to do things and get on with it. So that's my take. The credit markets, like I said, they're functioning. CLOs are being launched. We're seeing middle office activity. So yeah, it's right. It's not normal, but it's not totally abnormal either.
No, yeah. I mean, you mentioned like the impact on even travel, and I've seen headlines around that, and where maybe certain places are a little less willing to take in American tourists, while they're traveling now, and so maybe it's not so far of a bridge to cross to get to where investments are being impacted that way.
Yeah.
So that's a really interesting way to set the scene here. Now, in the syndicated loan in the private debt space, particularly, I think there's so much going on as sort of headwinds, right? There's also a lot of innovation going on to streamline the processes around loan data and around the middle office segment. So, could you talk to us a little bit about that now? I mean, we've talked with John and Jared obviously about this a bit, but I'd love to hear from your viewpoint.
Yeah, I mean, look, at a high level, right? This market is very antiquated. I mean, it's so antiquated, it's hard to believe sometimes that we're still operating on faxes. And sometimes these are faxes that have been scanned 3 times. They're blurry. They're hard to read. You think about the way that you execute trades. Like if you went onto Fidelity or Schwab or, any big brokerage platform, your trades are executed in a millisecond, right? And it's everything is sort of electronically transferred. It's just not the way it is when we look at the broadly syndicated loan markets and a lot of the structured finance areas. All of this stuff still happens on legal documents, and these legal documents can be 300 pages long, right? So now you have to sit there and sift through a legal document and extract out, maybe 60 or 80, 90 data points that you're trying to find. And that is still done very, very manually. So when I think about innovation, right, there's really 2 ways to innovate, right? You're either going to kind of build technology and scale, and we could talk about AI and things that are happening, some of the things that we're doing as well as an organization in that space. So that's one way. And then the other way is really around M&A, right? I mean, there are companies that say, look, if I want to get into this game, whatever this game is, do I either want to build it myself, or should I just go and acquire somebody else who kind of gives me instant access into that? So when I think about the innovation today in the credit space, I mean, that's really the 2 things that I see. For example, we're doing a lot around technology innovation, trying to drive more value to our customers, right? Better data access, better data endpoints, better APIs, better ways to ship data and receive data, all of those things. But also there's certainly, you see it today, you see a big thread around the M&A space. I mean, BlackRock bought HPS in order to get into the private credit area. And that gave them instant access to not just a lot of assets under management, but a lot of processes and technology. So it's really both of those that are, I would say, driving innovation. But technology is still a big player in that space. It's ironic that the data underlying the technology is very, it's manually intensive, it's antiquated. It's just a tough way to deal with it.
Right. And, and that's, innovation meeting reality. Right. And so I think about that. I'm like, so I just want to ask, why are we still doing it that way? I mean, is there somebody who's out there, just an investment bank who's sitting there is just like, no, we're not moving off of faxes. This is how we do things. And since they're holding out, everybody else has to stick with it. Is there a pair of cement shoes out there holding us back? Or,
it's a really good question. Yeah. It's, today, a lot of the data gets generated from agent banks. Mm-hmm. There's a whole slew of agent banks. So they have their own processes, their own ways of doing things. They organize their faxes or their PDFs, their memos in a certain way. There really is no standard. It is ironic. It's interesting. I mean, there are organizations like the LSTA that try to help promote standards, but there's nobody that, from a regulator has not said, hey, we want all, forms of global loan data to be in this standard format and to be able to be transmitted like over a Swift, message or something like that. Just haven't seen it. I mean, So far, some of the banks get together, right? And like we do as well. I mean, we try to get together with other counterparties and constituents and try to drive change and do things. But I also think it's somewhat maybe self-serving, right? The banks have their own process. They don't want to change. Is there an economic incentive for them to change? Maybe. I mean, maybe not. So they probably say, well, you know what? This is the way we do it here. And this is the way we're going to just keep doing it. It will change. I really do think that over time, the change will occur.
We just need a few of these agent banks to be brought out by private equity so they can do, a digital refresh for them, because that's what they do. They go in, they buy, they digital innovation, and then we all have fancy iPads that we can do all our business on.
Absolutely. I mean, somebody will crack the code, right? Somebody like you said, somebody will come in, find a way to say, you know what, just forget everything else. We're going to get all this data. We're going to normalize it and really try to enforce those standards within the industry. That's the key. I mean, and it's hard. So if you look at the explosion in private credit as an example, right? So we talk about broadly syndicated loans and global loan data and agent bank notices. That's all, for the most part, broadly syndicated type activity, which is difficult. We could talk more about the challenges around that. But then when you think about private credit as well, right? Because private credit needs the same kind of data components. But I mean, if I'm going to loan you, I'm making this up, but if I loan you money and I have my attorney draft a 100-page document, well, why do I need to conform to any market standards? It's a loan between you and me.
Right. So how much money are we talking about here, Scott, that you're gonna loan me?
Yeah, exactly.
I got the cameras rolling.
Exactly.
So,
Well, we have the lawyers on standby, so
Right.
we'll make sure it's whatever it is, tight covenants.
That's right. Yeah.
But it's like when you go get your mortgage, right? I mean, there's a certain, loan document. I mean, they're not all standard. I mean, a lot of the terms are very standard, but certainly there's some nuances there. So we see also this, right, gigantic explosion in private credit, and everybody wants access to the private credit markets, and that's also challenging because of the loan data, concept. Now, that could go away. Look, I mean, we went through this period where the banks had all of the deposits, right? A lot of people, you may have had your money sitting at a bank earning interest, but as rates started to rise, banks didn't offer higher yields. So a lot of people pulled their money out of the banks and they moved it into money markets or treasuries or somewhere else where they can get yield. And that is why, and one of the reasons why we see this tremendous rise in private credit, because the banks who historically had that lending deposit, that lending base, they no longer do. So there's almost been this shift in who is doing the lending, right? From the big banks to now private organizations. So we see a lot of middle market deals, club deals, private deals, bilateral deals. That's also a really big just rise in the market. So that's helping drive, to bring it back to innovation. That's helping drive a lot of the innovation. It's driving a lot of the M&A activity. And I do think over time that does push people to try to help normalize and standardize activity in the space.
Right. And, it does make sense, if you're an agent bank and there's no economic incentive to change what you're doing, then there's no reason to change it. So let's keep it the same. But as you mentioned, the private credit markets are growing. They're, some folks even say they would say equal size, as the broadly syndicated loan market. I don't know what the exact size of either market is here sitting in this chair today, but yeah, certainly a huge growth in private credit that we've seen that organizations like yourself are tracking and that we're tracking here. So maybe we should take a turn now and dive into some of the data, that we're talking about here. So, and I think more from like the managerial perspective, when you're, there's so much loan data out there, and for each loan, like you mentioned, so many data points that you need to be collating and sort of, making sure that you have accuracy in there. So when firms are trying to manage all of this themselves in-house, from your perspective and from what you've heard from the clients and the folks you're talking to in the market, what are the biggest operational challenges that they're facing?
So, when I think about the market in general and the challenges, the first is just that it's really manual. So if you're gonna handle these kind of operations in-house, and a lot of firms do, right? They have the kind of the capacity and they have the staff that do it. They need to chase down the agent banks, right? Because when you buy into a loan, you are named, obviously you're now named on the loan and you have access to the data from the agent bank. But, sometimes the notices come late. Sometimes there's changes. Sometimes you just don't get it. Like I said, like we talked about before, it's not electronic. So maybe you missed the facts. Well, maybe something happened on your loan, like there was a pay down or a rate reset or something happened and you missed it. So the first operational challenge there is just making sure you have the knowledge of what is happening on your loans. And, I've seen a lot of funds that handle this in-house and they do it, right? Because they want to have that control and that's fine. But there's a lot of manpower, a lot of labor required to really make sure you've got all of those agent bank notices pulled in, read, booked, making sure things happen. And we see this quite often. I mean, sometimes someone will buy into a loan and they miss something, let's say the loan hasn't settled yet, because it's not like, equity settlement. It takes longer. So let's say the loan has not settled yet and there's activity happening on your loan. You may not even be aware of it. So it's sort of like putting together Humpty Dumpty in a way, right? It's like there's a lot of pieces out there and these are highly active loans, right? So there's a lot of activity happening on them. These could be revolving credit lines. Some of them are like your credit card. It's a revolving credit line. One day you pay money back. Now I'm taking money out and maybe I'm traveling abroad and taking it out in a different currency. So there's different drawdowns in different currencies and rate resets. And there's just a lot of moving parts. So, so really there's a big operational challenge just in managing all of that data. And it's expensive. It's expensive to keep up that machine of always looking into the agent banks.
Yeah. And I mean, when you say how big, let's say a typical mid-market manager, right? Like how big of a team do you say they would need to have in-house to be able to manage it? I mean, how big are we talking here?
Look, I mean, it could be 20 plus people. It depends on the number of loans, depends on the number of deals and what's happening and the complexity. But I've seen plenty of back office and middle office operations that could easily be 20 plus people just trying to manage the loan activity. Right. It could be more. I mean, actually, I just met with a client earlier today, and they're very big in credit. They are 1,000 people worldwide today. They've got about 450 in their kind of middle and back office. So they're probably at the other extreme end because they do a lot of things in-house. But it gives you maybe a sense of the kind of balance you need, right? So maybe they're 50-50 between front office and then back office, which is a significant amount of capital, resources, deployment, right? Office space, all of those things to support that back office operation.
Right. And how does technology play into all this too? I mean, maybe this is a great time to talk about, you mentioned AI and some of the tech. John and I were talking, John Smolin and I were talking in our chat about, OCR and things along those lines, but, how does it play into, mitigating the risks of missing that, maybe missing that notice or.
Yeah. I mean, well, for us, so we are an outsourced provider, right? So firms that do not want to manage this internally, they come to us to manage it for them. So for us, we have a whole technology platform, but we also get scale. So if we're servicing one loan and it's broadly syndicated, odds are a lot of our clients are holding that exact same loan. So for us, when we book activity up here at a global level, we can kind of cascade it down to all of our different constituents. That's where firms will come to us because we can drive those economies of scale. Right?
So I'm guessing you guys have like a lot of fax machines.
So we back in the day, so a lot of it is e-fax now. So they come in by email and things like that. But back in the day, you would have hundreds of fax machines and they would just be going all day. But on a global basis, so for example, this year, we will probably process about 8 million agent bank notices.
Wow.
We'll probably push that limit in there. We're probably easily going to exceed, 5.5 to 6 million. I think we'll push up into the 8 million faxes kind of realm.
Wow.
It's a lot.
Wow.
And a lot of this, by the way, happens at month end or quarter end. So on a quarter end day, right, we may receive 250,000 faxes
All
on
on that day.
On a day.
Wow.
Yeah. So there's a lot to get processed. And that's why you need AI. You need technology, because if you're not going to sit there and get through 250,000 faxes in a day, no matter how many bodies you throw at it, right? So you really need some good
challenge
technology.
accepted. I want to
exactly.
Let's do it.
Get the goggles on.
You and me.
right?
Let's go.
Let's go.
we got this.
Let's see how many you can get through. Exactly.
Right.
That would be that would be a funny. That's the next podcast, right?
Right. Yeah.
We'll get the machines set up here.
It's little did you know this is turning into a reality show as we speak.
Exactly.
Right. We're gonna do more cameras, I think. So I mean, so things are evolving. Like, I mean, we're in e-faxes, we're talking, like technology, AI, is doing all this for us.
So we're using a lot of AI
right
in this process now.
Right.
I mean, we're still hybrid, right? We're not thinking that we're going to get to a place where AI takes over and there's no human intervention. But look, I mean, the reality is, I think for many firms, and we're on an AI journey, and we've been on an AI journey for quite some time. AI is a lot harder than people realize. I mean, you see it all over the news. It's like, oh, AI is taking over the world. It's right. It's kind of like everywhere. It's going to do everything. We're all going to be out of business. We have no more jobs. But the reality is that it's just not there. The main street message does not line up to the reality of today. Will we get there? There's no doubt we'll get there. But that journey is going to be way longer than anybody would think. And look, I was talking to somebody and they were saying they think, right, that we won't have doctors soon because AI is going to take over. We don't need doctors. I said, look, I still go to the pharmacy and there's somebody behind the counter counting pills, right? So let's first see if AI can do what a pharmacist does and count pills before we talk about getting the doctors out of the equation. So we're just not there yet. So, but for us, what we're doing with AI, our first kind of step is really in digitizing and kind of auto booking activity from those agent bank notices. Okay. Now, that may seem easy, right? It may seem like, oh, that's easy. You just kind of read the notices, pick off the data points. But there's a lot of nuances in there. There's a lot of complications. For example, when we get these, we use a lot of it's eFax. So we have some email inboxes that get stacked up with these notices. Sometimes you get spam. So you need an AI routine that can understand what is real and what is not real, or what is spam. And it's hard because all the notices are different, right? So when everything is different, you still need to get rid of the noise. So there's a whole routine that just says, okay, we need to get smart about getting rid of the noise. Your brain does it in a second. You look at your inbox and you're like, I mean, garbage, spam, junk, and you can pick it out in a second. The other thing is that sometimes these notices, when they're attached to the email, they're upside down. Now your brain in a second says, oh, look at that. The doc is upside down. I just have to rotate it. But the AI routine needs to learn and be smart enough to recognize that the document is upside down and it needs to be rotated right side up before it's actually read. And the other really great part about where we're getting a lot of benefits from AI is just in the fact that a lot of these documents, they've been scanned a number of times and they're blurry. And sometimes it's hard to make out the numbers even with my eyes. I mean, I'll read some of them like, is that an 8 or a 6 or, what exactly is that number? And the AI is really good at sharpening a lot of those blurry documents, where a lot of the legacy technology, they just really aren't that great. So that's where we look to get a lot of scale. Like we look at this and say, okay, this is a great kind of machine learning, AI process where we can apply this to millions and millions of documents and activity, and then, kind of carve out the data that we need, right? Normalize it, have it reviewed. We're still in for us, we still value the human intervention on that, making sure everything is correct and then getting things auto booked in.
Right.
But we're just much faster at it now.
That's great.
Yeah.
No. And then let's continue talking about technology, and let's talk about how it has evolved kind of in the broader middle office. Maybe we've kind of already touched on this, obviously, but with what you were saying now, but as you're looking at middle office services as a whole, what are the other areas where technology is really making waves?
Yeah. I would say we've gone through this period where, for a firm like us, people come to us because they want us to be their middle office. They want us to be their back office. They want us to do these kind of activities. There was a time where clients would say, this is years ago, clients would say, okay, you guys handle everything and then just give me my reports at the end of the day. That's kind of changed now. Clients want more interaction. They want more self-service. Although they are outsourcing items, they still want to have it's really a partnership, right? So they want the ability to enter certain things into a portal that can be updated into their reports. They want better APIs, better endpoints, better access to data. So for us today, that's really what's driving a lot of the technological changes, making sure we've got a really good portal for customers where they can run reports, they can access what's happening. And that's really our link to these customers and, in providing data and daily activity. I mean, I'll still say, look, at the end of the day, the technology can be great, and it is, but it's still a very much human expertise partnership kind of a story, right? What we offer clients is an exceptional partnership with a lot of expertise, which you're not going to get in the technology. I mean, we have technological experts, but at the end of the day, you need really good credit experts who know these markets really well that can help drive your operations as well. So for us, the advancements, the technological advancements are fantastic, and we couple that with just great people, and together we think that offers a fantastic balance and a fantastic partnership for folks.
Right. And so, talking about that relationship, how does a firm know when it's the right time to kind of make that relationship, to start that relationship, say?
Yeah. I mean, some firms, when they first start up, they recognize that they say, you know what, we don't want to do this in-house. We want to explore it. Sometimes it's as a firm is growing, they kind of hit their, I don't want to say their breaking point, but they hit an inflection point where they start to evaluate, should we continue to do this in-house, or should we explore external options? And that's usually where we try to work with them in a very consultative way and show them how we can drive, an exceptional back office, even though it's outsourced in a partnership type atmosphere. But I would say the moment of awareness for a lot of firms comes at different times, right? And some of it is you've got to give up some control, right? And there's for some people, they don't want to give up that control, right? But you have to if you're gonna use a firm like ours in this process. And sometimes firms are totally okay with it. So it really depends on where they land on the sort of the spectrum of doing that kind of work.
Right. Then maybe if you could talk to me about a real world example of maybe where one of your clients had seen their efficiency improve, around the technology and outsourcing, and maybe especially around loan data, particularly if you have anybody that.
Yeah. I mean, there's a number of examples, right? But certainly if a client comes to us or a prospect comes to us and says, look, we want to be onboarded within 30 to 40 days, as an example, which is really complicated. There's a lot of setup involved and the instruments and the assets and compliance testing sometimes, which can just take weeks and weeks and weeks. But we have a model down where, for example, we set up a very large manager who was launching or had about 10 CLOs and they were complicated. We had everything up and running in about 30 days, which is really aggressive. It was really, it was just a great partnership on both sides, working with them to make sure we have everything up and running in a very seamless way, get all of the integration tested, all of the data feeds tested, the dashboards, all of the ways that we're going to kind of work together. So that's just a really good example of where we can drive those economies of scale.
Right. And let's take a look ahead. I mean, this has been a great chat. I'd love to keep having it.
Sure.
Let's go on
with
and
fax
on,
machines next time, right?
Right. Yeah. 250,000 fax machines.
We're going to see how many we can receive.
I want one machine for every fax.
Yeah.
That's what I want. I want a stadium. We're renting a stadium for the next one. It's going to be like Mr. Beast.
We won't talk about the paper needs.
Right. It's all going to be sustainable growth
Yes.
forest. And the electricity will all be solar, right? So looking ahead, what does the future look like in middle office and sort of in the broader world of syndicated loans, private debt?
Yeah, it's always hard to predict the future, right? Because when you think that you've predicted the future, it's not. We didn't think in 2019 we would be talking about a pandemic and things like that. So things could change. Things can change very quickly. But I would say there's clearly a directional shift in the CLO market as an example, right? Where I would say there's more ETFs, there's more public access coming from a technology or innovation standpoint in the future. So, we've seen a whole host of ETFs being launched around CLOs. And I think the reality is that this market, which was once dominated by institutional investors, is becoming much more recognized and realized at the retail investor level. So I think that's that's really one big way. But, the markets are, the market is like trying to tame a monster, right? You think you can tame it, and then it turns around and rips your arm off. It's very, very hard to know what exactly is around the corner. So, we went through this period, like multiple years, right? Low volatility, everything was fine. And now we're in a higher volatility period. Maybe there's a sovereign debt issue unfolding, right, in the treasury markets. Who knows? So, it's hard to predict, but it really feels to me like we've got on the horizon, better access to the retail markets, more ETFs, and things like that. And I think, you've got a lot of sophisticated managers that are really trying to bring this market more into, more into the retail space. There was a time, back in 2008, 2009, where the talk was that these instruments were just going to go away. CLOs were dead. They were just going to completely evaporate. Nobody would touch them. And ever since then, we've just seen really constant growth. And the other thing I would say is that even in the market back in 2008, the great financial crisis, a lot of these CLOs performed well. And the reason they did was because a lot of them have a 7-year kind of time horizon where they're investing. And as the cash is coming in say years 1 and 2, the manager can continue to reinvest it. So sometimes even like today, where yields are going higher and everybody's interested in yield and credit, those managers are capturing higher yield in their reinvestment period. So they're not locked in for the full time period of the CLO without being able to capture higher yield, higher growth, things like that. So I think we're going to see, I really do think we'll see much more retail presence, much more penetration in the markets around some of these things. But beyond that, I don't know. I don't know where exactly this will unfold. It
really is anybody's game right now. Totally. No, Scott, thanks so much. It's been fantastic talking to you. It was great talking to John and Jared as well. Send them my regards next time you chat with them. And thanks so much to everybody who's listening here. This is Cloud9 Fin. My name's Chase Collum. I've been sitting here with Scott Alintoff. We're talking about global loan data, middle office services. And make sure to go back and listen to the other previous episodes with John and Jared if you get a chance. And if you have any feedback for us, send us a note at podcast@9fin.com. We'll be happy to hear from you.
Thank you, Chase.
All right. Thank you.